Good morning. You're watching Business World Live. I'm Danie Laurel. It's the start of a new trading day. Let's kick off with our banner story. The country's dollar reserves slightly rose in February. That's on the back of gains from the Bangko Central's investments overseas and foreign exchange operations. The Forex buffer climbed to 109.1 billion pesos last month. That's from 108.7 billion in January, according to Bangko Central data. Sufficient foreign exchange buffers protect the country from market volatility and ensure that it is capable of paying its debts. That's in case of an economic crisis. The end February gross international reserves is enough to cover more than 11 months' worth of imports of goods and payments of services, as well as primary income. Exports, meanwhile, fell 5.2% in January, while imports continued its downtrend at a rate of almost 15%. You can see on your screens here that brings the country's trade deficit to $2.4 billion, a decline of almost 31% year on year. Now recall that trade deficit fell at a slower rate in December to the tune of 27.4%. Of the top 10 major commodity groups for exports, 4 recorded annual decreases led by bananas and manufactured goods. Meanwhile, the sharp decline in imports was spurred mostly by industrial machinery and equipment, as well as transport equipment. Recall that economists were expecting exports to pick up by 3.6% year on year in January. Quick check on the local unit as, of course, our exports disappoint and contract instead of what analysts were hoping to see an increase. You can see on my terminal here the peso trading at 48.428 to the greenback. That is actually slightly stronger than what we were seeing the few weeks prior, but nevertheless still hovering over those levels, not necessarily breaking below the 48 levels here. Now let's move on to the equities market. I have to say it's a jump this morning of 0.2%, which is quite interesting considering that a lot were expecting that to be opening in the red, considering the horror show we have to wake up to biggest daily cases rising in COVID-19 in the past 6 months. So it's been the highest daily increase. That's 3,749 additional COVID-19 infections reported on Thursday. The confirmed caseload here in the Philippines is 607,048. Now, active cases are around 7.9%, so just a little over 47,700. And this brings the DILG to say that they will be releasing a memorandum circular mandating LGUs to impose travel protocols set by the IATF. Now, another thing that has been in discussion since last night, a blanket curfew in Metro Manila may return for 2 weeks. That might be starting from March 15. The MMDA chairman Benhur Abalos in a briefing said that mayors reached a consensus for a 10 p.m. to 5 a.m. curfew in NCR. So this move will be taking effect on the 15th. 17 local chief executives need to formalize it, however, but medical personnel, other essential workers are exempted from this. So let's take a look at which ones are actually bringing the index up this morning. Despite all of those heavy news, you can see AEV surging by 2%. Other companies here are a little bit of a mixed picture, but you can see conglomerates actually leading the charge here. San Miguel as well, Metro Pacific. On the downside, though, you do have DMCI down by 1.5% together with First Gen and Bloomberry. Now, I have to report a few earnings here before we move on. Converge in particular, that's been in the spotlight the past few days. They have just reported their 2020 earnings, and those profits seem to be sizzling amid remote work. So 74% up in terms of net income year on year to 3.4 billion pesos in 2020. That's on the back of revenues up by 71% to 15.7 billion. Now recall that residential revenues were the bulk of that doubled to 12.6 billion pesos, whereas the enterprise segment was up by 9%. Now, this, of course, happened on their IPO year, which did fund their expansion. They now are estimated to be present in 6.1 million homes. Now, recall that yesterday, however, we did see Converge losing 1.8%. It seems to be recovering by 0.12% this morning, trading at 17 pesos and 20 centavos. And finally, Emperador, another one that has seen quite impressive double-digit earnings despite this pandemic. That's up 18% year on year to 8 billion pesos on the back of revenues at 52.6 billion pesos. Emperador saying that the growth trajectory, particularly in the businesses in the US and overseas, offset the impact of COVID. So they also said that a lot had to do with the e-commerce business and that the global businesses adapted well to the new consumption trend. So Emperador trading flat right now at 10 pesos and 20 centavos. Checking in on the other headlines, we're keeping our eyes on the World Bank has approved a new $500 million loan to the Philippines to support the government's COVID-19 vaccination and economic recovery programs. The World Bank says the additional funding is meant to strengthen the country's health systems and overcome the impacts of the pandemic. Now, in April of 2020, the multilateral lender approved a $100 billion loan to the Philippines for its COVID-19 emergency response. It okayed another $500 million in loans to the government in May of last year. That was to provide financial assistance to poor households and small enterprises hit by the pandemic. Meanwhile, an earlier report by the World Bank found that the government's Pantawid Pamilyang Pilipino program, or 4Ps, has fallen short of its objective to break the cycle of poverty in the country. In its study, the global lender did not see any significant improvement in the education and labor market outcomes of adolescents receiving these cash handouts. That is even if they have been receiving 4Ps for 1.5 years. The bank concluded that beneficiaries need at least 5 to 7 years exposure to 4Ps for the program to actually improve their lives. The Pantawid Pamilyang Pilipino currently has 4 million family beneficiaries from the initial 300,000 recipients in 2008. Car sales continue to slump in February. That's despite recording a 12% improvement from January levels. The Chamber of Automotive Manufacturers of the Philippines, or CAMPI, reported that the industry sold 26,230 vehicles in February, 12% lower than the almost 30,000 units purchased in the same month last year. Commercial vehicles, which makes up 70% of car sales, declined over 15%, while passenger vehicles dipped 2.4%. Year-to-date, automotive sales fell 7.3% to more than 49,000 from the over 53,000 vehicles sold in the same 2 months of last year. Toyota Motors continued to have the largest market share at almost 50% after selling over 13,000 units, while Mitsubishi followed suit with more than 5,000 units sold. Just when we thought the worst was behind us, we are reminded that we are far from out of the woods. Here to tell us about what this latest COVID-19 case surge means for our economy, we have with us Sonny Africa of IBON Foundation. Good morning, sir, and welcome back.
Hi, morning, Danie. How are you?
All right, sir. Cases surging, another possible curfew looming here. There was always the possibility of that, even an expectation of that. We've been seeing that trend worldwide. We knew in a certain way this would happen. Can we still afford it? And do we now have the tools and the arsenal to arrest a new surge like this?
Apparently not. I think the government hasn't learned from the past year. It's still relying on population control, controlling individual behavior, like curfews, rather than sort of having a more positive way to control the spread of COVID. I mean, it's very strange that they're not actually tracing enough. The real key to controlling COVID is not the vaccines, it's not the lockdowns, it's upon good testing, having proper tracing, and then quarantining and isolating people, including incentivizing people to self-quarantine themselves. And the very, very odd thing is, this is sort of performative COVID response. You announce, you ban public displays of affection, you impose a curfew. But if we're not doing the tracing and quarantine isolating, I think we will still keep seeing this increasing problem with COVID cases.
Okay, that's very interesting, sir. But if we are to take your advice, or if the government is to go towards this path, then that would mean additional spending that they are saying, would compromise the fiscal discipline that they are trying to put. And we've just reported another loan na naman from the World Bank. To what extent can we balance here the short-term needs of expensive contact tracing, much more testing, versus just trying to organically live with the virus and go back to work with all of these risks?
Well, first of all, the DUF brags about over 13.5 right now with the new World Bank loan, almost $14 billion in COVID response. I think that's more than enough to actually put in place the proper tracing infrastructure and the incentivization and health system support to strengthen quarantine and isolation. So the big problem with this attitude of the government is reopening the economy. That's not really a strategy. It's just passively ending lockdowns that shouldn't be there to begin with if we had the proper testing, tracing, quarantine, isolating. So I think it's a bit contradictory for the government to claim 13, $14 billion in COVID response loans, but see at the same time, we can't afford to put in place the tracing, quarantine, and isolation infrastructure. So I think the big problem is they're being too conservative with the approach to COVID. We're not learning from what Vietnam, Thailand, to some degree, even Singapore has done recently. So it's not an individual behavior problem. That's part of the solution. But at the end of the day, the government has to take much more responsibility for containing COVID, not put the burden on people, not to constrict economic activity, not to stop people from going around with huge repercussions for depressing economic activity.
Sir, I know you're not an epidemiologist and you cannot necessarily predict the trends that are going to be happening here, but is it too late for the government to be focusing on that? You mentioned that that should have been done at the early stages before, even imposing all of these lockdowns and then reopening the economy. Now we're here. Now we have gone to a point where they're already saying we cannot go back to another lockdown. We cannot be doing these things. What's the best course of action here when it comes to imposing curfews, as you mentioned, behavior, and trying to get the unemployment levels lower than what we've seen in January?
Well, I think exactly like you said, we have to reopen the economy. I mean, the depressed economic activity right now, the worsening unemployment, that's hitting the poor and middle class the most. So on that premise, the real solution really is to improve our tracing. I remember Mayor Magalong had a report around January or February. We were doing about 1:6 or 1:7 contact tracing. That's just like close contacts in the immediate family. He also said that in rural areas, we need 1:25, 1:30 contact tracing. In congested urban areas, up to 1:37. So I think it's very odd for us right now that the Department of Health, IATF, is not talking about improving our contact tracing numbers. And if that's not being done, we're being forced into a situation where lockdowns are being used with all its adverse economic effects rather than containing the virus in a more rational way. And then, like you said, living with the virus, which is, it is there, but dealing with it is not, dealing with it with lockdowns is not actually dealing with it. It's just pushing us into a corner with even worse economic repercussions down the road.
Okay, sir, let's move from the virus figures towards the economic data figures. Are you at least seeing signs of a recovery and signs that we've already bottomed out, at least in terms of unemployment rates, even the corporate earnings have been hit already, and they seem to have been recovering. The foot traffic, for example, consumption seems to be getting higher. Do you at least see this when it comes to the economy that's going to be better in 2021 than it was last year?
I think we have to be clear. The economy and the labor market has rebounded, but from the low levels of the lockdown in April. But I think
Okay.
if the government took a longer view from the rebound in April, looking at the July, October, and then the recent January figures, it's bottomed out at a very low level. Employment figures are not really improving compared to the April lockdown. So they've improved since the April lockdowns, but they're still much less than over the past 3 years. Unemployment right now is actually, it's about 4 million reported, but the real figure is probably about 6 million. In terms of employment generation, employment now is lower than it was 3 years ago. And actually, employment now is lower than in July 2020. So I think the flattening of the employment generation, that's the good sign that, sorry, it's a good indicator that the labor market conditions are not improving, the economy is not recovering, and if we're not seeing an improvement in the labor market figures, we won't see an improvement in people's household consumption, we will see continued depressed economic activity. And I think what you said earlier about the monetary measures, it's not going to work. I mean, the government can keep on focusing on supply measures, monetary, financial measures, but without fiscal measures to improve the demand side, supply won't create its demand. On the contrary, demand creates supply. And if the government does not have a real stimulus program in place in terms of the demand side, you won't have actually businesses borrowing, you won't have the economy recovering. And that seems so straightforward. It's a straight jacket of fiscal conservatism that's keeping us, I think, as down as we are right now.
But sir, would you say that at least the preemptive stance of the BSP to ease ahead of all of this GDP contraction to some extent cushioned the blow?
On the contrary, I think the government's general stance has made the blow worse. Right now, we are paying the price of no stimulus last year. I think despite the hundreds of billions claimed under Bayanihan 1, those are mainly realignments from the 2019 and 2020 budgets. So there was no stimulus last year, which is why the labor market is so depressed right now as it is. And of course, the BSP's measures, you need that, but you need to complement that. Actually, we argue with the more important demand side measures, which the government, out of its obsession with credit worthiness and the fiscal deficit, that's actually keeping us repressed. That's going to be worsening revenue generation in the years to come. That's going to make debt more unpayable. That's going to make the economy more depressed than it actually could be.
Okay, and one last question, sir, before we let you go on consumption and consumer confidence. A lot of economists, analysts are banking on the fact that Filipinos just like to spend. And once, the labor markets are open again, once you have vaccines, once people are back and getting salaries, they are directly going to go to the malls, eat out, and this is what's going to lead to our recovery. Can we bank on that? And to what extent is this something that we can believe in, that once things are in place and once the COVID cases have actually been contained, this can directly drive a recovery?
I think Filipinos, like everyone, like to spend. That improves your welfare. But the Bangko Sentral itself admitted in the last quarter of 2020, 3 out of 4 Filipino families don't have any savings. And as long as you don't have enough jobs to increase incomes, to increase people's spending power, we're not going to see that real recovery. And I think we should be very clear. What's happening in 2020 is in 2021 will be a rebound, but it won't be recovery unless labor market conditions improve, unless businesses have the confidence to borrow, hire people, and then set in place a virtuous cycle of job hiring, increased income, spending, more investment, and down the line.
Okay, thank you, sir. So, of course, good reality check for everyone here is going to be a long road to recovery. Thank you for those insights. Very useful. Sonny Africa, IBON Foundation.
Thanks, Danie. Keep well.
And that's a first look into the business day. Today is March 12, 2021. Catch Business World live for the market closes at 3:15 p.m. today. I'm Danie Laurel. Mask on, wash hands, stay safe, Philippines. We are One News.